$400,000 a year software engineer and $120,000 a year consultant walk into a room. The consultant builds $5M in assets by 55. The engineer retires at 65 with $2M. The difference isn't talent or IQ, it's lifestyle lock-in, and it's the career ceiling nobody talks about. Research shows that high-income professionals don't hit a pay ceiling. They hit a lifestyle ceiling, and once you cross it, the math of risk changes completely. Let's start with the data. According to BLS Occupational Employment Statistics, software developers, the highest paid entry point career in America, are projected to grow 25% through 2032. That's 23,000 new positions annually. Median annual salary is $120,730, but that's deceptive. At major tech firms, a level 5 software engineer mid-career pulls in total compensation between $300,000 and $450,000 when you factor in base, stock, and bonus. An L6 senior hits $500,000, $800,000. And yet, according to Glassdoor aggregate data and industry surveys, most engineers in those bands report feeling financially stuck. Why? They aren't stuck because they can't earn more. They're stuck because they can't afford to risk earning less. Here's the trap in detail. When you earn $120K, your housing is probably $1,500, $2,000 per month. Your car is paid off or financed modestly. Your kid's school is public. Your vacations are regional. Your lifestyle is roughly 60–70% of gross income. The math is tight but survivable. Now imagine you get promoted. You're a senior engineer or a manager, or you jump to a better company. Your total comp jumps to $350,000. Suddenly everything changes, not because you change it consciously, but because your environment changes. You buy a house in a better neighborhood because you qualify for $2M mortgage instead of $600K. Not because you need to, but because the bank will lend it. Your kid goes to private school because you can now afford it, even though you couldn't before. Your car is a new luxury sedan instead of a 5-year-old reliable one. Your vacations are international. Your restaurants are the ones that require reservations. Your partner may reduce work hours because household income is high enough to cushion it. Your spouse's career stalls slightly, not catastrophically, just enough that one income truly is household income now. Research from the Federal Reserve Survey of Household Economics and Decision-Making shows that households earning $200K plus spend 85–92% of gross income, compared to 70–75% for $100K earners. The effect is consistent. Higher income correlates with higher expense ratios, not lower ones. This is lifestyle inflation, and it's mathematical, not moral. Now here's where the ceiling forms. At $350K total comp, you have maybe $35K, $50K annual surplus after taxes and expenses if you're disciplined. That's real money, but it's not escape hatch money. It's not I can take a 40% pay cut and be fine money. It's I can max my 401K and buy some index funds money. But the real risk-reward moves, the ones that build $5M in assets instead of $2M, require exactly that kind of flexibility. Consider the scenarios. Scenario A, stay at your current job. Promotion to L7 in 18–24 months, average promotion velocity in tech per industry surveys. Total comp jumps to $600K, $800K. You get a 30% raise, but your lifestyle has already locked you into $300K annual expenses. Your surplus grows to maybe $80K, $120K annually. Over 20 years, even with investment returns, you hit $2–3M in net worth. You retire comfortable but not wealthy. Scenario B, take a risk. Use your $350K L5 title to start a consulting firm with 2 ex-colleagues. Year 1 is messy. You make $180K. Your household income drops to $220K partner's income. Your lifestyle collapses hard. No international vacation, no private school. The house feels tight, but you learn how to sell, how to manage margins, and how to operate a business. Year 3. You're doing $600K in revenue at 35% margins. Year 5, you're at $5M revenue, 40% margins. You hire a team. You sell the firm for $4M. You're 42 years old, but here's the blocker. Scenario B is only possible if you can survive on $180K without catastrophic family stress. If your lifestyle has expanded to consume $280K, $300K annually, scenario B becomes impossible. The risk is no longer financial, it's psychological. You can't take it because your family needs the stability. That's the ceiling. It's not a pay ceiling. It's a risk ceiling created by a lifestyle floor. The data confirms this pattern at scale. Analysis of layoff data from 2022–2024 shows that employees earning $150K plus had significantly longer reemployment searches than those earning $75K, $150K, despite being more skilled and better networked. Why? Because the $150K plus earner couldn't accept a $90K role, even temporarily, without triggering family stress and debt acceleration. The lower earner could pivot faster because their lifestyle had more elasticity. Let's talk about the second mechanism, promotion velocity itself. BLS data and industry compensation surveys show that advancement velocity in high-paying fields slows measurably after a certain income threshold. Tech engineers see average promotions every 18–24 months from L3 to L5. from L5 to L7. The window stretches to 24-36 months. From L7 to L8, many never make it. The roles are rarer, the politics are thicker, the bar is higher. Meanwhile, outside those traditional ladders, alternative income sources, consulting, product work, starting a company, building an online course, advising startups don't have the same ceiling, but they require runway. They require the ability to make less money temporarily while building something that compounds. Here's what the highest earning individuals actually do. Research into ultra-high net worth individuals, those earning $1M plus annually from multiple sources, shows they don't follow a single income path. They run parallel income streams. One, core W-2 income, often $200K, $400K, that provides stability and cash flow. 2, equity stake in a company they founded or co-founded, the wealth builder. 3, consulting or advisory work, the leverage multiplier that uses their core expertise, but with higher margins than employment. The consultant earning $120K in the original example likely had $60K from direct client work, $40K from 3 advisory board positions, and $20K from a small product or course. None of these alone would be impressive. Combined, they create optionality. And optionality is the currency of high net worth. The $400K engineer, by contrast, had one income source. That's not a weakness in isolation, it's a weakness only relative to what's possible. If that same engineer had kept their lifestyle at $120K, $150K annual spend while earning $350K, they'd have $200K annually to deploy toward equity stakes, side ventures, or consulting work. Over a decade, that's $2M in capital to invest or deploy. Now they have optionality too. The research shows a clear pattern: income not equal to net worth, margin not equal to income, and optionality not equal to skill. But how do you actually escape the lifestyle ceiling without blowing up your family? The answer isn't to cut your lifestyle in half overnight. It's to decouple lifestyle growth from income growth. Here's the mechanism that works. Each time you get a raise, whether it's a promotion, job change, or new income stream, commit to spending only 50% of the new income. A $50K raise means a $25K increase in lifestyle. The other $25K goes to investment or capital deployment. This keeps your expense ratio from accelerating beyond your income growth. Over time, this compounds your optionality. Data from wealth building studies shows that individuals who follow this pattern reach 7-figure net worth in 15-20 years of $150K plus income. Those who spend the full raise take 25-30 years if they get there at all. The second mechanism is to intentionally build skills that have market value outside your current role. Research shows that professionals with 3 or more credible revenue-generating skills, not certifications, actual revenue, earn 40% more over their careers and have 3x the optionality when it comes to risk-taking. Why? Because side income de-risks the main move. If you have a consulting practice that can generate $30K, $50K annually, you can suddenly afford to take a $100K pay cut for an equity opportunity, because your household income is still stable. The third mechanism is to reframe promotion as a capital-building tool, not just an income tool. When you accept a promotion, you're buying optionality and credential value, not just salary. L6 title at Google is worth more than $500K on the market. It's worth the ability to consult, join boards, or start a company with credit.